Let's look at how we can determine consolidated current assets at the time of an acquisition. Okay, so here's the problem, right? On January 1st, 2010, POC Corporation and Spratz Corporation had condensed balance sheets as follows. Okay, so we've got all the information in front of us. On January 2nd, 2010, POC borrowed the entire $84,000 it needed to acquire 80% of the outstanding common shares of Spratz. The loan was to be paid in 10 equal annual principal payments plus interest beginning December 31st, 2010. The excess consideration transferred over the underlying book value of the acquired net assets was allocated 60% to inventory and 40% to goodwill. And we're asked to determine the consolidated current assets at December 2nd, 2010. Okay, now for these numbers, the critical numbers we need to keep in mind is that Spratz's book value of the net assets was $84,000 and current liabilities was $14,000. Now let me slide down and show you how we solve this. And we've got to do it step by step. First, let me show you the entries that are made. Okay, POC is the parent company. Now, when they borrow the money, this is the entry they make. They debit cash $84,000 and borrow and credit notes payable. Now that they have the money, they use it to acquire the stock on the open market, or I'm assuming the open market. They acquire it from whoever the owners are. And so they record an investment in Spratz of $84,000 and use the cash that they acquired. Okay? But they only acquired 80%. So we've got to stop and determine the fair value of the company. Well, the fair value of the net assets of the company is actually $105,000. Here's how we know. They paid $84,000 for 80%. So $84,000 divided by 80% gets you $105,000. Okay, so there's my calculation, equals $84,000 divided by 80%. That's $105,000. The net book value of the net assets were $70,000. Now you can see it in stockholders' equity, but I like to actually consider it the direct way. $84,000 book value of current assets less $14,000 of the current liabilities. Okay, so when I slide that up, or actually let me move this out of the way now. What we now have is a calculation of the excess paid over book value. But they tell us we have to allocate 60% to inventory and 40% to goodwill. So let me slide up a little bit more. We'll show that. Okay, there's our allocation, 60% to inventory, 40% to goodwill. How did I do that? I took the $35,000 times 60% and the $35,000 times 40%. Okay? Now, let's think about what consolidation entries would be made in this case. And I'm going to do them all as one big entry. That's the entry that would be made. Okay, we're going to write up the inventory for the amount that was allocated to it. That's $21,000. We're going to write up the goodwill, since that isn't reflected on the books, and we have to enter it in terms of the consolidated entity, and that's $14,000. Now, we have an investment in Spratz on the parent's books of $84,000. We need to write that off when we consolidate the income because that will no longer appear. It's appearing in consolidated form, so we consider all the net assets. And then we have to record a non-controlling interest, and the non-controlling interest would be equal to the fair value of the assets times the percentage we don't own. That's 20%. Okay, now, if I add up all the debits, I get $105,000. I add up the credits, I get $105,000. So I'm reasonably assured my entry is correct. Now that I do this, I can answer the final question. Let me slide this away, which is, what's the consolidated current assets? Well, POC had $99,000 on its books. Spratz's book value was $28,000, and then we're going to add to it the $21,000 that we allocated to inventory. So the consolidated current assets of the organization will be $148,000. Now let me just slide up to show you where the 99 and the 28 came from. Okay, I'll slide back down. And that's this problem, everyone. Thank you.